All right. Good morning, good afternoon, ladies and gentlemen. Um, Very delighted to welcome each and every one of us to this year's Association of Asset Custodians of Nigeria's annual Nigeria Investor Day. All protocols duly observed. I'd like to um, especially appreciate all our guests and all everyone invited. Thank you for making our time. I mean, just a quick welcome and kind of background to this event and what we've done in the past years. This is an event that we started 10 years ago, and we're having the ninth edition today, um, which is um, which is a virtual event. I think we couldn't uh, gather last year because of the pandemic, but it's with excitement. I welcome each and every one of us to this year's event, which is going to be the first one we're hosting virtually. The last time we had this event 2 years ago, 2019, in London. I remember it was a very engaging day we had with an array of speakers. The event was graced by the governor of the central bank, and I remember clearly it was at that event that he did announce the renewal of his term of office. And I recall he also made some interesting commitments to the portfolio investing community around the waiver on BVN and co. If I recall correctly, I think some of the takeaways from the event 2 years ago had to do with the issue of icing, use of icing in the Nigerian market for all fixed income securities. And as at the time too, we had some teething issues on the CCI platform, a lot of which we as an association took away. And in course of today and tomorrow, you're going to be getting some updates in terms of where we are as a market, what changes have been implemented, what changes are in pipeline, and what more. If we look at the structure of the conference this year, because it's a virtual event, so the association has decided to break it into a 2-day event of 2 hours each. So today we're going to be spending 2 hours together, and then we hope to gather again tomorrow virtually to spend 2 hours. Today promises to be very engaging. If I look at the agenda that's been shared, we have the honor of Mr. David Cohen from Citibank, speaking to us on the macros, while we will welcome the DG of SEC, to give us to engage with us in the fireside chat, right? And we've also got a very experienced network manager speaking to us on the expectations of the network management community, because of some changes we've seen in the market as well in terms of the 2020 finance bill, right? So we're very privileged to have an experienced tax expert in West Africa who sits in Nigeria, coming from Standard Chartered, Mr. Toyin Ojomalade, who's going to speak to us on what are the tax implications of the new law, right? And we'll wrap up today, with closing remarks from the Vice President of the association. So, for the sake of people that may not know, my name is Biodun Adebimpe. I work for Rand Merchant Bank Nigeria, and I'm the current president of the Association of Asset Custodians. I think without further ado, we'd like to ask each of us to feel welcome. And I'd like to hand over to Mr. David Cohen to speak to us, to talk us through the macroeconomic part of this conference. In the course of today, I'm sorry to add, if you have comments, you'll be able to drop your comment in the Q&A session. And we've got our operator who will monitor that box, and then you get a chance to have answers to your questions or comments as we go. Thank you. Welcome one more time, and I wish us a very insightful, engaging, and stimulating session. Thank you. David, over to you.
Okay, so okay, yep. So hopefully you can hear me now.
Yes, we can, David.
Okay, thank you. So what we then saw was that Nigeria published its first quarter growth statistics. It's led the way in that respect. It's usually ahead of the curve, which shows you that you had a very, very small positive growth number in quarter 1, 21. That will probably gain momentum, but Nigeria is behind the recovery, particularly if you look at somewhere like Ghana next door to you, although they haven't published their first quarter GDP data. Really, if you look at the composite index for economic activity that comes out from the statistics office in Accra, what you really see there is that there's quite a big rebound in activity. And one of the ways to think about it is that you would expect West Africa probably to gain more growth momentum in the short term versus East Africa. And the reason for that is that, Eastern and Southern Africa tend to have much larger tourism industries, which have an important impact on the economy. West Africa doesn't have such an important tourism industry. Moreover, commodity price developments in West Africa are pretty favorable towards many of the countries in the region, right? So if you think about it, oil prices have recovered pretty quickly in 2021. We've also seen that gold prices have remained high, which benefits places like Ghana, Mali, Burkina. And then cocoa prices have also remained pretty okay over this whole period. So the commodity price factor is dragging West Africa forward a little bit, and then that's helping. The other place that's really benefiting in Africa from the commodity price rebound is, of course, the copper producers. The DRC and Zambia could both benefit, particularly Zambia after the elections, because the Chinese rebound that we've seen has had a big impact on copper prices. So you've got this picture where Africa was pretty resilient in 2020. Yes, economy slowed, but there is now a recovery. The question is, will that recovery be greater or worse than what's going on in the rest of the world? And in the Nigerian context, the way I talk about it very much is that will the recovery be hampered by poor economic policy? The other point I make, and this is on the slide that you can see now, is that there's a human cost to the COVID-19 crisis. This slowdown in growth has had a human impact, right? And the way to think about it is that people on this call, most of us talking and listening, are probably pretty much unaffected. We can work on Zoom, we can do things like we want to, we've carried on working and getting paid for it. But the sector in Africa that's got hit the worst is probably the informal sector. People who had a small business that relied on face-to-face contact, people stopping and buying food at a small restaurant, or even if you were a street hawker, you would have been impacted. And you can see that very clearly. What the National Bureau of Statistics did in Nigeria in conjunction with the World Bank was it produced these economic reports that were very clear, that showed you that employment, and that's probably more important in the African context than unemployment, fell very sharply in Nigeria. So it fell from like 85% in January, February 2020, down to 40% of people claiming they had work by the time you got to April, May. Those numbers have rebounded, but what you also have to remember is that, you know, we look at the latest data, it's telling you that 85% of Nigerians claim to have work again. But in the course of 2020, they had to run down their savings. And what we've also seen is that many have moved into agricultural occupations. So if you look at that same data produced by the National Bureau of Statistics, it shows you that agricultural work is now more important in Nigeria. And so the agricultural sector has acted as this social safety net. It's not like in Nigeria or the rest of Africa where you would have been put on furlough for your job, especially if you were the informal sector. You've had to go and make do and get through it. And that will be a constraint on growth going forward. When I talk to our corporate clients and I talk to the people in the fast moving consumer goods sector, what you have to argue a little bit is that consumption levels will only return to the level you saw at the end of 2019, probably in 2022, 2023. So Tola, if you jump to the next slide, the other thing I'd make to you is that we're still very uncertain. I show this graph just to show people, look, the forecasting going into the 2020 slowdown was pretty inaccurate if you look at it, right? In the end, as you can see, the light blue line is showing you that Nigerian GDP growth contracted by minus 1.8% of GDP. The IMF was very negative about how the impact would be. You can see that at the middle of the year, in the middle of 2020, it thought that the economy would contract by over 5.4%. If you look at me, interestingly enough, I still thought that you would get positive growth like this in 2020, such as you've seen in a number of countries, Ghana, Egypt. And the reason I thought that was I was very surprised that Nigeria imposed the full national lockdown that it did. For example, Egypt has never had a full national lockdown. It's had a curfew, yes, it's had constraints on movements, and it's had positive growth, right? So I was a little bit surprised about the extent of that, and that's probably what drove you into this contraction. But what it reminds you of, this graph, is that you have to be a little bit careful. We're all very uncertain about how the recovery will gain momentum. And we saw that in the first quarter growth numbers. So look, if you jump to the next slide, you can see where the consensus for the recovery is, in that you can see that here we have the growth numbers picking up there. And most of us expect growth to be around somewhere 2 to 2.5%. Looking at the first quarter growth numbers, I'm still wondering whether we're all a bit optimistic. And in fact, we may only see growth of 1.5%. It depends a little bit, if you look at this graph, on what happens in quarter two. Remember that the issue is that when you had that big contraction of minus 6% in quarter two, 2020, you get a mathematical rebound in quarter two, 2021. So, for example, if you see that the quarter two growth number comes in at 3 or 4% year on year in quarter two, don't get carried away by that, right? It's partly mathematical rather than necessarily a true reflection of what the economy is doing. The other point is that, look, if you look at that graph, what it's showing you quite clearly is that the agricultural sector in Nigeria has had quite good growth in recent years, but it's still a bit low by the standards of sub-Saharan Africa. So, you know, agriculture, although it only accounts in most African economies for between 20-25% of GDP, it actually still accounts for well over 50% of employment in most of the economies. And as you can see, yours, agricultural sector growth in Nigeria has been well below 4%. Most African countries, it's much closer to somewhere between 3 and 4.5%. And so that still hangs over the recovery, whether there can be a more significant pickup in agricultural sector growth, which is important because agricultural sector incomes then drive the recovery because they're quite significant consumers. The other areas where potentially you could see a pickup faster than what you expect overall, and if you jump to the next slide, Tola, you'll see that, is that these three sectors could show more recovery over the course of 21, right? So crude oil, natural gas, manufacturing and construction. If you look at the graph, you can clearly see that construction was very badly affected by the lockdown. The question is whether now the lockdown is lifted, we can see that picking up a little bit more, or whether the approaching election makes people a little bit uncertain. For crude oil and natural gas, remember the key is not so much the oil price, it's about the level of production. And one of the very interesting features that we've seen in Nigeria in the course of 2020 was that historically Nigeria has cheated on its OPEC quotas. But in fact, in 2020, Nigeria was the chief enforcer. Muhammad Buhari and the energy minister were the chief enforcers of the OPEC quota across Nigeria and Africa. So the question would be how much you see a recovery in oil and gas production. And that, of course, could also be determined by the passage of the petroleum industry bill going forward. So those, if you wanted me to guess, are three sectors that could outperform. Maybe you could add the finance sector to that. What I'm seeing when I look through the results coming out of the finance sector is that the first quarter results for the listed banks have not been particularly good. And that reflects exchange rate issues, but it reflects the low interest rates. But as we'll talk about later on, there has been a recovery in nominal yields in this first half of this year. So that may show in the performance of the financial sector in the second half of this year. So that may also perform to the upside, but there's a bit more uncertainty about that. So a slow recovery is what we predict. The other point I'd make to you, and if you look at this slide, is that probably one of the problems we have is that the oil price recovery has now run out of steam, and you have to be a little bit careful in thinking about it. If you look at Citi Research forecast for where the oil price is going, yes, it remains high in 2021, but it starts to traipse back off down in 2022 and then into 2023. And so that could also be a problem. And the reason I put that there is just to show you that it's something we need to think about when we work about what the outlook will be in the next 2 years, right? So we should not assume that we're heading into another commodity super cycle and the oil price will be at $100 for the next few years. Although there is some discussion that may occur. But at the moment, if you look at the forecast, that's not the central scenario. And that's important for thinking about Naira dynamics going forward, right? So that's the final thing. But remember, going back to the growth story, it's not the oil price that drives GDP, it's really the production level. So it's an easing of the OPEC quotas that will allow a greater recovery in the oil and gas sector. So that's sort of the growth story. The other point I would make about it, and this is where Nigeria is weaker than other countries in Africa, is that if I look across the continent, I do see a much bigger rebound, I think, in first quarter growth. And the problem for that is still probably the constraints of domestic economic policy in Nigeria. The 2 points I make, and what have been highlighted again by the crisis in 2020, was that, look, the reality is that the government in Nigeria really cannot drive a recovery. It's just too small. If you look at Nigerian government spending at under 10% of GDP, you know, if they doubled spending, which they just don't have the capacity to do in any spend, that would impact on growth. I mean, okay, across Africa, governments are small, but still most governments are getting out the door somewhere between 15 to 20% of GDP in terms of expenditure. So you're kind of nearly half of that. So the small size of government always constrains whether it can drive a recovery. And, you know, even if you run a big fiscal deficit of 5-6% of GDP, that will only have a minimal impact on growth. That means that really The big concern is all about how monetary policy can help the recovery. And so I think that's important. What we have seen and what makes Nigeria quite different from the rest of Africa is that the central bank has run this unconventional monetary policy. And so because of the size of the Nigerian domestic financial market, it's been able to really force down interest rates and still lower its monetary policy rate, even though that it's going against the inflation trend. And look, you can see very clearly on the next slide how that plays out. So here you can see that inflation has been rising, but the Central Bank of Nigeria has still been able to push down the monetary policy rate and the overnight borrowing rates. If you look across the rest of Africa, just to give you an idea, what you've seen is that central banks have been able to cut rates, but unlike in this graph, mostly rates have remained positive in real terms. The South Africans have run a very minor positive negative real rate, and the SARB does seem quite desperate to return to normal positive real rates in the coming months. But broadly across Africa, rates were cut, but they remain positive in real terms. So Nigeria stands out as an exception. Now, whether you think that policy response has driven inflation up, is a debate, but my argument is it probably hasn't. So look, if we think about the inflation dynamics in a little bit more detail in Nigeria, and we jump to the next slide, what you can see is that what the problem you've had in Nigeria in the last year and into this year is really a food price inflation problem. So if you look at the change in the month-on-month in food price change, or in the CPI, what you see is that food price inflation really is outstripping it. And historically, as the graph shows you, that has been a problem in Nigeria, right? And the reality is still that Nigeria's CPI basket, where food accounts for 50% of the basket, is still very high, even by African standards. So the CPI basket, if you look more generally across Africa, what you notice is that food accounts for between 30 and 35% of the index. So you're on 50%, that's significantly higher. I would point out to you that obviously the National Bureau of Statistics has started to do a rebasing of Nigeria's GDP. Now, that won't be finished this year. I suspect it will probably happen next year. But as part of that, you will see a rebasing of the CPI index, right? Because the two tend to work in conjunction. And in that, I would expect the percentage of food as the portion of the basket to fall, right? It may not fall down to, say, the levels you see in other parts of Africa, 30, 35%, but I certainly would expect it to probably be more in line with somewhere like Egypt at around 40% of GDP, maybe a little bit more. So to look more at the importance of food, Tyler, if we jump to the next slide, you can see that really clearly here, right? And so the food price inflation, the light blue line there, is really, really taking off on the government. And that's the problem that it has. And there is a little bit of an argument to defend the central bank governor that, really what he does in terms of monetary policy doesn't really matter so much. It's about whether it rains. And the point I make is, obviously in a multi-religious society like Nigeria, it doesn't really matter what God you're praying to, but you're praying for rain to help you, right? But having said that, some of the policy choices have also impacted on food price inflation. And in particular, yes, Nigeria's had a problem. In fact, bizarrely enough, last year, the problem was not necessarily too little rain, which historically has been a problem in parts of Africa, but too much rain that you've had in Nigeria and floods that have impacted on food prices. And the point you would make, though, is that too much rain is an easier problem to deal with. But one of the problems we've had is that the FX shortages in Nigeria and the problems with the exchange rate have meant that the availability of fertilizers and seeds has also been negatively impacted. And so that's contributed to this food price inflation surge that you've seen in Nigeria. And so do we think that will run its course? Yes, I do. I do expect inflation to peak. And if we were to jump back to the previous slide and look at the cycle, what you tend to see here is very typically in Nigeria, when you get to July, August, you see that as the harvest really hits the market, food price inflation does tend to come down. And we would expect that to logically happen. And so what you have now is that inflation will probably trend down to around 11, 12% by sort of early 2022, but certainly by mid 2022, assuming that, you know, the harvest is large enough to work on the market. So that's the macro, the broad macro picture. The problem for Nigeria in the next 2 years is low growth and high inflation, double-digit inflation. In fact, look, just generally so you get an idea about this in the wider African context, there's 4 countries, particularly in Africa, that have double-digit inflation of the same level that they have in Nigeria, right? They are Nigeria and Angola, Zambia, and Ethiopia. And all of you have similar elements to that inflation. You have high food price inflation due to drought, locusts in Ethiopia, due to drought in Angola, due to too much rain in Nigeria, too little rain in Zambia, against the backdrop of this exchange rate problem. And so the lack of availability of FX or the rapid depreciation, for example, of the Zambian kwacha is leading to these big inflationary surges. So inflation of these high levels is much more uncommon across the rest of Africa. In fact, inflation is pretty well behaved. So stagflation, unfortunately, or low growth and high inflation for the next 2 years. If we jump to the next slide, Tola, we'll start talking a little bit about the Naira and how we think how the government can get out of this. Now, what I want to stress to you is that going into this crisis, and it did seem, or many of us had hoped, that the central bank governor, Mr. Emefiele, would not repeat the errors that we'd seen in 2016-17, and in particular led to the introduction of the NAFEX market in mid-2017. Just for your information, I've been through 3 big exchange rate crises in Nigeria now. The first one was when Mr. Soludo was the governor of the central bank, and he came to London and spoke to us a lot about that, and they actually implemented the devaluation in 2009. Then obviously we went through the 2016-2017 devaluation, and now we've gone into the third one of these. Now, if you go back and cast your mind back to May, June last year, what you saw was the finance minister announcing that she expected that Nigeria would be able to raise about $8 billion from multilateral lenders. So what she spoke about at the time was that she said, okay, we're going to get this disbursement of 3.4 billion under the rapid credit facility from the IMF. And in addition, we're going to get this money from the World Bank, from African Development Bank, from some of the other multilateral lenders, such as the Islamic Development Bank. And the total would have been about $7-8 billion. Now, what it struck me at the time was the plan was that they were going to take that money, use it to boost reserves, and allow a very gradual adjustment of the exchange rate. And if you talk to the IMF and the World Bank, what they will tell you is that the plan, it wasn't that it was enforced upon Nigeria, but the Nigerian authorities had agreed that there would be exchange rate unification. So you can see that in the graph. What that has meant is that the CBN has gradually allowed the CBN rate to move towards the NAFEX rate. And of course, you know, if I was to take this graph on, now we know that the CBN rate and the NAFEX rate are one, they are merged. But what the CBN hasn't done is it hasn't allowed the NAFEX rate to move to a fully clearing level. And that's the problem, right? Because that's meant the shortages have started to build. And so that's created the whole problem within the FX market. Now, what that's meant is that the World Bank has refused to disperse its money. So that's been very clear from the World Bank side. The World Bank has made some comments saying, really, it doesn't think the authorities are serious enough about their commitment to the reform. And late last year, in about September or October, the World Bank got in a little bit of a battle with the government, in that the government owed it repayments on, or some of the electricity companies owed it repayments on the loans that the World Bank has made to the sector. And they were claiming that they couldn't make the repayments because they couldn't get the dollars on the FX market. And that got the World Bank back up really quite a lot. And the World Bank was saying, well, why would we lend more money to you when you're not repaying the money we've got? And so this unwillingness to adjust the NAFEX rate is really where the problem has come. Interestingly enough, after the 2017 introduction of the NAFEX rate, we went down and spoke to Kofi and the FDMQ and all those guys, And he thought that the introduction of the NAFEX rate would make an adjustment easier at the times of stress, because his argument was you could just move the NAFEX rate and the CBN rate could remain where it was. That doesn't, unfortunately, seem to have materialized. So the question is, can they move the NAFEX rate, and do they have to move it as far as where the parallel rate is to actually get a market clearing situation? Well, look, there seem to be a number of plans in place to allow some movement of the NAFEX at some time, I hope, in the next 6 months. So if we jump to the next slide, I'm hoping this is going to show me something, right? The first point, no, jump forward another slide, Dola, please. And one more. Here. So what they announced in particular earlier this year was the introduction, or late last year, of this treasury bill that has a zero coupon instrument, so essentially it's the applicable yield at issuance will be determined by the CBN. So the banks will also be able to sell that to institutional investors. So the plan, as it looks to me, is that somehow they hope that they can attract institutional investors back in the market. Now you can see on the next slide, we have started to make some progress towards this. So this unconventional monetary policy, the cutting of the CBN rate, pushed interest rates down, particularly on short-dated instruments, the 91-day T-bill, the 364-day T-bill. But what you're seeing now is that the central bank, since early this year, has started to let these rates recover. The 10-year bond is now around 13%. And so what you're seeing is that we believe, or I hope, that the central bank thinks that it can start to get close to attracting institutional investors back into the FX market. So this is my thought process about what they're trying to do. First, you've seen the recovery in the oil price this year. So you saw the earlier graph on that. That's allowing some increased liquidity on the FX market and the CBN to sell. What it's done is it's started to more aggressively clear the backlog to institutional investors on the NAFEX market. Corporates have still got a pretty big backlog, maybe 4 or 5 billion, but the institutional investor backlog has been closed down quite a lot. Secondly, you've seen interest rates start to rebound now. So the question for an institutional investor is, if the backlog is cleared, at what level of interest rate and Naira rate will I be prepared to re-enter the market? To give you an idea just how much money there is floating around in Africa this year, because you're the only continent, not the only, but the main continent in the world that has really high interest rates, right? We currently have a little bit under $30 billion invested in the Egyptian debt market. For the first time I can remember, we have significant trades going on in the Ghana debt market, Uganda debt market, the Kenya debt market, and the Zambia debt market. So all the markets, bar Nigeria, are seeing inflows into that market. So if you want my guess, probably if the CBN was to allow a devaluation, probably down to around 430, 440, maybe as low as 450 on the NAFEX market, and the 10-year bond was trading somewhere around 15%, I think you would start to see flows coming back into the market from institutional investors. They would be small to start with, but as we know, those portfolio flows, because they move on to the NAFEX market and are cash rich, they do create quite a lot of liquidity quite quickly. The final element of the strategy, as I would put it, that I think the central bank is imposing or wants to impose is that, unable to get the World Bank money, it's now increasingly likely that the central bank, or the government, I should say, will issue a Euro bond in the course of the second half of this year. So if they were to come to the Euro bond market with a a $3 to $4 billion Euro bond issuance, they could use that to build reserves. So what you've got is that they used a Euro bond to build reserves. You've got extra liquidity created by the rise in oil price. And then if they adjust the Naira not down to where the parallel is, but enough to attract institutional investors, that would provide the liquidity, and we would see a slow normalization of the NAFEX market. And in a way, the point I make is that Mr. Emefiele could present that as a clear win, right? If he wanted to, look, all you have to do is look at the performance of the Nigerian Naira versus the Angolan Kwanza this year, right? The Kwanza has collapsed all the way down to where it's currently trading about 650 to the dollar, right? And so the issue you would have about that is that, you know, by moving it only from 365 to somewhere about 430, 440, 450, then you haven't implemented the same severe devaluation that the Angolans have had to do under a conventional IMF program. And so that could be presented as a win. So that's sort of how I hope. But the point I would make is that the progress has been glacial. You know, if this strategy has been in place for quite a little while now, probably since late May, mid-May, even before that, actually. And so it's a slow progress that they're hoping the normalization will have. The final point I would say is that I don't expect a new exchange rate regime to be introduced by this current government. The question you'd have, and go if you went back to that earlier side about my oil price forecasts, is that one of the things is that you can move the oil price forward, right? You can move the oil price forward. You probably have to go back to, I think, on that, Tola, a bit more. But you can move the exchange rate, but as the oil price drops back off again, the question you would ask is, how sustainable is that even going forward? My answer to people is probably that they will keep the rate at around 450, 450, around that level. So you would still have liquidity issues in the market. But I really don't expect the introduction of a new exchange rate until after the election. So you're really looking whoever replaces Mr. Emefiele as the governor of the central bank, I would suspect. But hopefully, and certainly talking to custodians, there will still be enough liquidity in the market and interest rates will be high enough to attract investor inflows. And of course, a movement in the Naira may also attract some more equity inflows. I mean, again, the equity question is just the same. If you go and talk to foreign equity investors late last year, the recovery you saw in the Nigerian stock exchange was sufficient for them to not get too worried about a devaluation, but they would still want to be able to get some of their money in and out. And it's the liquidity that's driving the problem. So look, Tola, let's jump to the final side. I've probably spoken for enough now, and we probably want some questions, right? But we go to the conclusion of where does all this leave us, right? Now jump back one for Nigeria. So look, the short term is we expect this weak recovery in GDP growth, inflation to remain in double digits. We expect this normalization of monetary policy to happen, but interest rates will still remain negative in real terms. The reality is that that's not a particularly good position, but at least it's a position that we know and we can work and live with. Meanwhile, look, all attention starts to focus on the elections, right? We're already seeing the noises pick up, the battle for who will control the APC as we run into it. That will all play out over the coming year and a half, right? And then I think the way, and this is particularly when I talk to corporates, is we hope that after the elections, there's some chance of changes in the policy environment, certainly a move to a much more logical exchange rate regime, and then we go forward. I'm personally not so optimistic about the political outcome, right? I think there's potential for bad outcomes, there's potential for good outcomes. But the way in broad terms, the way I think about it is that, look, Nigeria returned to civilian rule in the mid-90s, in 1994. The first Obasanjo administration was, bogged down with all sorts of problems. It got its act together when he was re-elected in 1999, and Nigeria went through a boom of 15 years, from 1994, to 2014. So actually nearly 20 years, right, when the oil price turned down. Since early 2015, it's made policy mistakes, right? And those policy mistakes have largely been around the exchange rate, and that's meant that growth has been much weaker, and we've had this period. So if you get through the elections and you start thinking more logically about exchange rate policy, then I think there's no reason why you can't see a much more fundamental pickup in the economy again. I also think that you've ended a period, right? Buhari was welcomed when he was elected by many people because of, his anti-corruption stance. but in another way, he reflects the legacy of military rule in Nigeria. And whoever takes over the presidency, I think, will be, someone who hasn't got that military background, is a much more different, hopefully more dynamic person. I mean, I'm really hopeful that, we don't see a return to some sort of negative figure. The other point is that there are still some structural reforms being implemented by this government that would benefit not this government, but the incoming government. The most important is the petroleum industry bill. If they can push through the petroleum industry bill in the second half of this year, that could mean that even if the oil price falls back in Nigeria, you can see a recovery in production. One of the things you've seen in Nigeria in the last few years is that production has been on a downward trend. Don't get too bogged down by problems of green growth and stuff like that. Yes, in the short term, demand for oil will still exist in the emerging world. And Nigeria is one of the few places on the planet where oil companies can get quite big fields back into production. If you think about Shell's Bongo Southwest field, this is a 150,000 barrel per day oil field. There's not many big oil fields out like that. If the PIB sets the right terms for that, it's perfectly possible that Shell will push the green button to go ahead with that, right? You then also have, remember, with the PIB, the fact that a lot of the new production will have a lot of associated gas. Hopefully what's happened in recent years will mean that that gas has to come on, and the government will get serious more about electricity sector reforms, how that gas is going to be used. And then the final point, look, the Dangote oil refinery, we've talked around this a lot in recent years. Remember, it doesn't actually have much of a huge impact in terms of growth, or even on the current account necessarily. But what it does is it takes away a huge sinecure for corruption that's existed in Nigeria for the last decade, right? And that in itself is a hugely positive thing, right? So when I talk to corporates, and I'll talk to you in the same way, you might get a bit more lucky because we might see the return for institutional investor flows into the equity and FI markets, even with this policy constraint. But really, we're now sort of hunkering down. This is the environment we're going to live with for the next 2 years, but let's see how the politics plays out and where we go after the February elections and whoever's sworn in early May and May 2023. So that's the sort of the broad picture, which I hope you can now think about and discuss going now. But I'm happy to take questions, talk a little bit more about any of the points raised there, anything you want to you want to try and resolve in the next sort of 15 minutes perhaps.
Thank you very much, David. I think your presentation brought quite a balanced view in terms of, what we are seeing from a short-term, mid-term, and long-term perspective. And it also did give a view from both a fiscal and policy, as well as with respect to how the central bank is dealing and managing her core responsibility and as well. I think we have a few questions from our audience, which we would like you to take at this point. And I think I would read through a few of those. I also have a few participants who would like to ask you a question live, and I will check if there's any. So I have Patricia Royal who would like to ask a question at this point. Patricia will give the virtual lectern to you for you to go ahead. You can go ahead and speak. Thank you. Patricia, we've yielded the lectern to you. Could you go ahead and unmute yourself? All right, Patricia is not, okay, go ahead, Patricia.
Do you hear me?
Yes, perfectly, thank you.
Excuse me. Yes, Patricia Royer from Société Générale in France. So thank you for this presentation. Could you come back on the central bank policy when you said that there could be a good impact on the liquidity if NAFEX was maintained between 430 and 440? You can come back on this point, please.
Yeah, look, we've had enough discussion with institutional investors over the last sort of how many? 6 months, let's say 6 months, right? About what their thinking is on Nigeria, right? So obviously until recently, interest rates weren't attractive enough. But what you're really looking at when you're an institutional investor is at what level of interest rates and what level of the Naira to attract me back into the market, right? And so that's the question you're asking. Now, one of the points I make is that everyone looks at the parallel rate and says the Naira has to devalue to the on the NAFEX market to the parallel rate to become market clearing, right? But that's not usually the case. If we look back at previous devaluations of the Naira, what we tend to see is that you tend to see that the Naira on the formal rate devalues, and then the NAFEX rate generally moves back or strengthens towards the Naira, right? So to the formal rates. And what you see at times of stress, like we've seen in the last few years, is that obviously that puts a lot of pressure on the parallel rate, and so that's why it blows wide. So the question you're really asking here is if interest rates go back up to, like I said, about the 15% level, at what point, what value of the Naira would be attractive for foreign investors or portfolio investors to want to buy Nigerian treasury bills? And so you would look at it and say, it's probably going to be somewhere around 430 to 450. You could do another calculation on that if you wanted to, right? If you looked at the last IMF data that they produced, they estimated that the Naira was 17% overvalued. So if you wanted to go to a real value, looking at the value of the NAFEX rate when they did those calculations, you would say that the Naira has to move to around 460, 465, right? But that's the basic question we're looking at. Even if interest rates are attractive, you won't see institutional investors returning to the market if they don't think that the NAFEX market is clearing. But if they do, and the Naira has adjusted sufficiently, then I think they'll come back in quite large numbers, potentially quite quickly. So you're looking at a NAFEX rate. Like I always say 445, 450, right? But it could be anywhere between 430 and 465, right? It's a very imprecise science for knowing how much it has to adjust.
All right, thank you.
Thank you, Patricia, and thank you, David. David, I have another question for you. This question is from Rotimi Adebi. It says, do you envisage foreign direct inflows in Nigeria in the midterm, despite the security situation in the country, or should we just be looking in the interim at foreign portfolio flows? What are your views on that?
Yeah, I mean, look, FDI has obviously declined into Nigeria in recent years. You can see a lot of it. Now, there's two clear reasons for that. The first one is that the lack of passage of the petroleum industry bill, the lack of clarity about the conditions which oil companies will be working in under Nigeria, has meant that oil investment has declined significantly, right? And then the second one is, it's not really so much due to the security situation, it's due to the FX issues, right? And when I talk to corporates, there's this strong sentiment that we've been beaten over the head by all these FX issues in 2015, 16, and now again in 2020. And so we've slowed down our investments into Nigeria, right? So those two factors have led to a sharp fall off in FDI. Now, I've been speaking to corporates quite a lot over the course of the last 9 months. Those corporates that haven't exited the market are beginning to think a little bit about what they want to do now. And just to give you an idea, on Friday, I did a call with a pretty large corporate and they wanted a 10-year outlook discussion on where Nigeria and actually Ethiopia would be in 10 years, right? And so, you know, that's still the reality that some people, you know, and look, the reality is that the population dynamics, when you look at the population dynamics of Nigeria and Ethiopia, you're going to have another 30, 40 million people in there, that some of those consumer companies are going to want to take advantage of that. And we even did a call with corporates the other day where one corporate was very clear, this is the time to double down on Nigeria. Just as people are getting negative about it and selling out, it's probably the time to double down. So I do expect some recovery in corporate FDI over the coming years, but it may not, you know, people will be positioning, making a decision. Do I just hunker down now till the elections? If the elections turn positive, would I put money in immediately after that? Or would I then decide that I'm not going to do it? So that's a battle all corporates have to take place. The other thing, of course, is if the PIB is passed, the Petroleum Industry Bill, that would lead to a recovery in FDI from the oil sector. And that tends to be a little bit sort of crowding in of other FDI, right? When the oil sector gets more confident, you see the FDI numbers come out, everyone gets a little bit more confident about Nigeria. So, you know, I'm not overwhelmingly negative about FDI. I just think probably it won't gather pace until we have more news on the PIB, until we have a clearer idea of where the politics is going to go. The conflict, I don't think really impacts on people's thought process yet, right? Yes, we're seeing conflict in the north. I still can't work out whether that conflict is just part of the natural cycle of conflict we've seen in Nigeria, or whether it's a, you know, a more sustained effort that it will gain pace and become more difficult, right? Remember, look, you know, my memory is quite long on this, right? As I point out to people, you know, over 10,000 people died in the first Obasanjo presidency from a result of internal ethnic communal violence in Nigeria, right? And we're not back to that level yet. And you're looking at a lot of complicated factors. Some of the violence in the north, you know, seems to be this internal battle between ISIS and Boko Haram. You know, there's this battle about ISIS more generally across Africa. Is it looking at it as the final frontier, the problem you have in Mozambique, obviously in the wider Sahel region, and then in Nigeria? Some of the more ethnic or more ethnic pastoralist settlement violence, you know, maybe that's an effort by some of the herdsmen to take advantage of the fact that you have a Fulani president and he's in his final term. So I'm not sure that that's sort of just a surge that we're seeing now, or whether there's more long-term fundamentals to it. But for most investors, the key market in Nigeria remains the coastal region, right? You know, you draw your line, you go from Ibadan through Lagos down to Harcourt. That's where your big market still remains. And that FDI, you know, as long as the violence in the Middle Belt or the North certainly doesn't come down there, that's what people are really looking at. So I wouldn't be too optimistic about FDI in the short term, but I think, you know, PIB is passed, politics looks like it's improving, then I think you could see a return in investment. And like I say, corporates are looking at Nigeria in the long term.
Thank you, David. I think we're doing well with time. Very interesting views. Thank you. I think two more questions before we call it a wrap on this session. I have a question from Kabila B. The question is, isn't the CBN operating a counterproductive policy by pushing for growth with its loan to deposit LDL policy and withholding USD, or wondering why there is a substitution for USD when a lot of manufacturing inputs is imported? Any views on that, Dave?
Yeah. I mean, look, the way I think AACN, you know, our City Sub-Saharan African CEO, AACN, is based in Lagos. And we've had this discussion a lot, right? And I think AACN puts it pretty damn spot on, right? What his argument is that the average person on the street in Nigeria knows the value of the Naira, right? And if the Naira was to go to 500, 600, just like you saw the Angolan Kwanza go, right? Then you would see an uproar on the streets, right? And that's where they feel the pressure. The average Nigerian doesn't really care about the growth numbers, right? You tell them that growth in 2014 was 7%, they'd say, we don't believe you. You tell them growth is now 1%, they'll say, I don't believe you, right? Things are hard, right? I had a presentation I had a presentation based on one of the new Nigerian books come out that the country is not smiling, things are hard, right? And so they don't really care too much about where your growth numbers are. So unfortunately, the CBN has got stuck on this idea of preserving Naira stability as much as it can, and kind of they don't worry so much about the growth outcomes that produces, right? And that's the problem. Now, you could go back and say that's an unfortunate outcome that happened in Nigeria. The big problem we had in Nigeria was really ultimately the death of Abai Kayera in early 2020 as a result of COVID. Because what it really had seemed before that happened was that the Economic Advisory Committee, Salami, Doyon Salami and Bismarck Rouhani, did have an influence, and we might have seen that there would be more adjustment of the FX if he had stayed in power and the Economic Advisory Committee got to it. Unfortunately, the appointment of Ibrahim Gambari as the chief presidential advisor has blocked that, right? And we've gone back to this sentiment: exchange rate stability matters more than anything else. And you're seeing that play out, unfortunately, even though I agree with you. You could argue it's illogical.
Thank you, David. I think the president of the AACN has a question. He has his hands up. So Biodun, over to you.
Thanks very much, Tunde, and thanks, David. I think your presentation actually answered a number of questions in my mind. But just a quick one, David. We've seen a bit of disparity in GDP growth projection from IMF compared to what the Nigeria Bureau of Statistics has come up with. And even the last GDP report numbers kind of, they're not well aligned. I just want to get your own view in terms of your GDP growth for Nigeria, given where the market is at today, and then the crude oil prices rally that we are seeing. We're yet to see the impact of that on the real economy. What would you say the GDP, in your view, will be the real GDP growth rate for Nigeria?
Yeah, I mean, it's an interesting one. I mean, the IMF has battles with statistical agencies across Africa about GDP growth rates, right? Actually, tomorrow I'm talking about Tanzania, right? And interestingly enough, if you want the biggest battle over GDP growth rates in Africa, it's between the IMF and Tanzania, right? You look at the Tanzanian growth rate, it gets stuck at 7% for most years. And basically the IMF just does not believe it, right? My general take is that the National Bureau of Statistics is pretty, it's okay. It's doing the best it can, given the difficulties of collecting data in Nigeria. Let's not underestimate that, right? What I think the problem has arisen with the IMF a little bit is that the IMF models, I think, when I look across the whole of Africa, is that first, look, the reason I presented that earlier slide was that nearly all forecasts got the COVID slowdown wrong, right? And the reason for that is that from a GDP perspective, it was very hard to know how locking down economies would actually impact on GDP, right? I've been through 3 crises in Africa, as I said to people. I've been through an HIV/AIDS crisis. I've been through a global financial crisis. I've now been through a COVID-19 crisis. And all of them have different impacts on the economy, right? So I think we were all groping in the little bit of the dark. If you really do shut down an African economy for 3 months or 4 months, how would that impact? So the IMF was overly negative about that. But that also reflects something, right? The IMF wants a crisis in Africa. When there's a crisis and it lends to Africa, in a little way, that's what its raison d'etre is. It wants to engage with the Nigerian government. And one point I always make about being the IMF resident rep in Nigeria is that, look, you're sitting in Africa's largest economy, but ultimately you really have very little impact on policy. Nobody really worries about you too much, right? And that's quite a problem for the fund, right? This is Africa's largest economy. It wants it to do well. It wants to have an input into economic policy, but it doesn't really have that. And so it gets a little bit frustrated. And I think that's why you see sometimes it it has a slight negative bias towards some of its projections on Nigeria, because it wants the government to realize that it needs to act and get its policy in the game. You could say, in defense of the IMF, that investment bankers are always too rosy about Nigeria, and they always think things are going to improve, right? And I could be as guilty of that, of being too optimistic. Like you see my presentation on the post-election outcome, right? So you should always view these projections through people's slight subliminal or subconscious bias, right? So that's the one way of thinking about it. But I also think that there's a problem here. And remember, the problem is this, that when you went at the start of the COVID-19 crisis, one of the things that I think really was clear was I saw lots of projections, not just for Nigeria, but across Africa, saying Africa has the lowest number of hospital beds per person and things like that. And if COVID impacts, right, it's going to lead to this overwhelming health crisis. And what we saw in the end was that for whatever reason, Africa's death rate from COVID doesn't seem to have been that bad, whether that reflects Africa's young population, whether that reflects that people live outdoors a lot, there's a lot of sunlight, whether you think that just the nature means that Africans generally are exposed to more viruses, more diseases, have stronger, robust immune systems that allow them to get through it. So I think what I think it shows you is that the modeling didn't get the resilience of Africa. One of the things I say about it is Africa in the last 20 years has shown a lot of resilience. Things don't fall apart. South Africa shows you that you cross over, you become slightly more of a middle income country, and then it becomes harder because people expect the state to provide hospital beds. But in Nigeria, people don't expect the state to provide hospital beds. People get ill, they get better. So I don't think the IMF models captured that resilience very well. It'll be interesting in the recovery whether that resilience also translates going forward. And it's something I'm actually writing now. What do we expect in terms of recovery? Do we expect this more modest recovery like in Nigeria? Or as I said at the start, if you look at Ghana's short-term measure of economic activity, its composite measure of economic activity, that would show you that in Ghana, there was a really big rebound in GDP growth in Q1. So I think that battle's coming out, right? But it shows us that as economists, we're still struggling to fully model these African economies and capture the resilience, the underlying resilience in many of them.
Thank you very much, David. These views are quite useful. It helps also to set the tone for the rest of the conversation that we'll be having today and tomorrow. Talking also about the IMF, we have the country representative of IMF, Mr. Ari, who will be joining us first thing tomorrow at 9:30. So it'll be good to have that view as well. So thank you again, David, for joining us today. We'll go next into the second item on our agenda, and we have Harry Chatanya, who will be introducing the Director General of the SEC, who is also here present. Harry actually heads the Investor Services Product Department at Standard Bank Group, and he will be helping to champion, the conversation with the and the speech made by the DG. Harry, over to you.
Thank you, Dimash, and it's a great pleasure to be part of this event today, and also my pleasure to introduce Dr. Lamido Yugada, who's the new Director General of the Securities and Exchange Commission, with an extensive experience over 3 decades in central banking, accounting, finance, economics, and investment management. He has a sterling record at CBN, managing reserves, also his stint at IMF as an economist. So I think without further ado, I would like to, invite him and then share his opening comments.
Good morning. Can you hear me?
Yes, we can, DG.
Okay, thank you very much. The President, Association of Asset Custodians of Nigeria, distinguished captains of the capital market, esteemed capital market investors, ladies and gentlemen, I consider it a great privilege to deliver these remarks at this gathering of capital market professionals, investors, and other stakeholders. I thank the Association of Asset Custodians of Nigeria, the organizers of this event, for this invitation. The theme of this year's conference, Nigerian Capital Market, the Road to the New Normal, speaks to the urgent need to develop and adapt to new ways of doing things in order to achieve a capital market of our dreams. I believe that the Nigerian economy can blossom when the potentials of our capital market are duly unlocked, especially now that we are beginning to see the end of the COVID-19 pandemic. I'm particularly delighted with the presence of our esteemed investors at this year's Investors' Day. Investors are central to the functioning and success of our market. Hence, the Commission's core mandate is protecting their interests. Several provisions have been enshrined in the Investments and Securities Act of 2007 and in the Commission's rules and regulations to ensure the achievement of this critical mandate. For instance, operators are prohibited from commingling investors' funds with theirs. They are also mandated to treat fairly all investors. In addition, the Commission requires the capital market operators and issuers provide relevant and timely information to enable investors make informed decisions. Stiff penalties are imposed when these provisions are violated. To further improve investors' experience in the capital market, we have tasked our operators to update investors' KYC information. This is necessary to deepen the participation of retail investors in the capital market, limit fraud, and ensure that all investors benefit from their investments. In further pursuit of its core mandate of investor protection, the Commission recently held an interagency engagement with the National Information Technology Development Agency, NIDDA, on the Nigerian Data Protection Regulation, NDPR, to ensure operators handle investors' data in a safe and legal manner. In this regard, I urge investors to fully cooperate by continuously updating their data as required with the relevant market operators. The Commission has also undertaken several initiatives to restore confidence and attract new investors to the capital market. The participation of institutional and retail investors, especially young investors, is crucial for the growth and stability of our capital market. Additionally, in the new normal, it is crucial that we leverage technology in achieving improved investor participation. This explains our renewed interest in fintechs and in related regulation. We have developed rules on crowdfunding, robo-advisory, and digital sub-brokers in order to expand asset classes and attract more market participants. I therefore use this opportunity to encourage fintech firms to approach the Commission for due registration of their capital market-related activities or for participation in our regulatory incubation program. Several initiatives that we are currently implementing derive from the 10-year Capital Market Master Plan 2015 to 2025. One of such initiatives is the ongoing drive for e-dividends registration. The system enables shareholders' dividends to be paid directly into their bank accounts without the stress of dealing with physical dividend warrants. To this end, we commit to ensuring that investors are promptly paid their dividends. May I also use this platform to urge investors that are yet to mandate their accounts for e-dividend to please do so. Where such investors have used different combinations of names to subscribe for public offers, such names can now be easily consolidated into one under the regularization of multiple subscription window. Investors can thereafter claim all their shares and accrued dividends. Our direct cash settlement initiative also protects investors from funds mismanagement by ensuring that the process from sales of their shares are credited directly to their own accounts as against those of the stockbrokers, thereby eliminating the risk of mismanagement of sales proceeds. To ensure the availability of hedging products for investors seeking to manage their investment risks, we have finalized related rules and the necessary framework to support the introduction of derivatives into the Nigerian capital market. We have registered 2 central counterparties, as well as developed other necessary mechanisms for derivatives trading to take off. Given these initiatives and others, and with your support, we are confident that the Nigerian capital market will be the preferred investment destination for both local and foreign investors. On our part, we shall continue to improve the processes for issuance, trading, and investing in the Nigerian capital market to ensure a better investor experience. Once again, I thank the Association of Asset Custodians of Nigeria for organizing this event and wish all participants a fruitful deliberation. Thank you.
Thank you very much, Dr. Gada, for this your comments, and I think it's been very encouraging to know the focus of the SEC on the the new investor protection norms, the data protection laws, introduction of derivatives market. I mean, clearly these are the things which has been on the radar of the investors. I think equally the Commission's focus and interest in introducing of the new products in the market, and especially as you mentioned that on the post-COVID environment, the whole focus on the digitization of the market, the removal of the manual processes. So I think the measures taken by the Commission in terms of e-signatures or e-voting processes will definitely help in streamlining the capital market processes. I mean, attracting in new investments as well as more investments from the existing investors into the country remain a primary objective for all the players, that and especially considering that in the last few years there have been decline on that front. So I think collectively as an industry and the regulators to see how we can bring the investors back into the market and address some of the feedback which we keep hearing. Well, thank you for your time. There have been a lot of interest and a lot of questions from the players, but since in the interest of time, and you have already what the association will do, I believe they will share those questions with your office separately, because I believe you are pressed for the time right now. But on the behalf of the association and personally for me the opportunity to here participate, I thank you and hand it back to the host, Timaj.
Thank you very much. Really appreciate it.
Thank you very much, DG, and thank you very much, Harry. These are indeed tough times, but indeed this message coming from the DG would help cushion the effect and also reassure investors around how friendly our environment will be going forward. So thank you very much, DG, for participating. We hope to host you again next year. Maybe this time not virtually. Maybe
Okay.
vaccines would have been, implemented across the nations, and we'll be able to sit physically with you, not virtually. Thank you again.
Thank you very much. Really appreciate the invitation, and I wish you successful deliberations.
Thank you, sir.
Thank you.
Thank you, our guests and esteemed participants. At this point, we'll go to the next item on our agenda. We'll be having a conversation, and this time around, the conversation will be more or less going to the investors and hearing from the investors directly. It's important for us to have a view as to what is the expectation from the market, what's the expectation from financial market infrastructure, participants in the market, what indeed will bring investors back into the market like we had in the past. And we'll be having a representation from the global custodian, the network management team, and that panel will be hosted by Lola Aluko. So I asked Lola Aluko to introduce Olu, and then we'll go right into the conversation. Thank you. Lola, back to you.
Yeah, good morning once again, everyone. I want to welcome everyone again to this year's Investor Day, Investor Conference. Many thanks for giving us your time. I will be having this conversation with Mr. Olu Oshineye, who is a network manager with BNP Paribas Security Services. He currently manages major markets in Africa and Middle East, including Nigeria. And he has had over 20 years experience, covering the full value chain across operations, project management, client development, and network management. So, Olu.
Yes, thank you. Pleasure to be here.
Yeah, thank you so much for joining us. So with all that's happened in the past 18 months with the COVID-19 pandemic and the resultant effect on the global economy, it's very important for us to always have sight of what is important for our foreign portfolios investors in various capital markets, and we have to always keep updated on the expectations that these investors have, as well as the expectations of the network managers of the global custodians that represent them in our market. So our conversation this morning would center around that topic. So I think maybe, Olu, we should start the conversation with you giving us an overview of a typical day, in the life of a network manager in terms of your day-to-day activities, your client expectations, and what you do on a daily basis.
Oh, that's a good start. So first of all, a very warm indeed morning to everyone, the captains of the Nigerian industry, my peers in the network community, foreign investors and local investors, and all other attendees. It's a real pleasure to be here. Oh, so where do I start? So what's a normal day like for a network manager like myself?
Yeah.
Very busy, especially right now, challenging, never a dull moment, so much to do. But in short, a normal day right now currently comprises of stringent monitoring of activities in the market in terms of risk, compliance, asset safety, ensuring minimal impact on our clients, as well as preparing for on-site due diligence visits. In addition, what with this ongoing pandemic, I've also had to incorporate tasks such as assessing cyber risk, disaster recovery as part of my day-to-day task, ensuring all arrangements are in place with our agents and FMIs to a best-in-class standard. In this ever-changing industry, what with new products like ESG and digital assets, I've also had to become more familiar with these products in order to ensure I keep up to date with our clients' requirements. Also, sometimes I almost feel like a lawyer because not only do I have to review contracts, but I also have to ensure there's a valid legal opinion in place per market. So, in a nutshell, what's a normal day like for me? No day's ever the same. Very, very busy and never a dull moment.
Yeah, thanks for that insight. I think then we can dive into the topic. If we go generally, what are your clients, as well as you as global custodian, what are your expectations of any market that you and your clients would like to invest in? So not just Nigeria, talking about any market globally.
Okay, thanks for that question. So, as an investor, prior to investing in any market, there are a number of boxes that needs to be ticked. And this range in no particular order from having a free flow of currency. So FPI, foreign investors want to be able to invest seamlessly, but just as important, they want to be able to repatriate whenever they want to without any blockages.
Yeah.
Also, have an effective regulation, such as a workable insolvency law, which will allow investors in the unlikely event of any insolvency to be able to retrieve their assets in a timely manner without any issues. It's good to hear the Director General of the SEC mention that there's a Data Protection Act in place, because that's also very important in order to ensure that our data is kept secure and safe at all times. Also, stock exchanges need to have an array of sustainable listings. And this is very important because in this current day and age, incorporating ESG criteria into decision-making processes can now be seen as a good function of good investing. And with the increasing number of millennials attracted to investments and their strong allegiance to ESG, they're starting to realize that they can address their sustainability concerns through their investments. And according to the respected Morningstar, last year in 2020, investments in sustainable funds assets hit a record $1.7 trillion. So that just goes to show the importance of having sustainable listings. Easy access to market information and transparency is another key area. And it's very important to be kept abreast as investors of what's going on in any given market, be it in relation to regulation or maybe operational, as well as being informed of the impacts that can have on investors. And this is very important because this can have a huge bearing on investors' investment decision-making processes. Having effective financial market infrastructure in place that can cover the full value chain of operational activity is also a key requirement. Also, having the full end-to-end connectivity from front to back with no manual intervention, as this enables the elimination of all operational risk. Diversification of products such as securities lending and derivatives are also important, in addition to the vanilla offering, of course. And of course, last but not least, having a stable government is of paramount importance, as political risk could impact investors' returns, especially if there is political instability. I think I'll stop there.
Yeah, thanks, Olu. Yeah, I agree with you. A number of those points that you've listed are quite important. Being a relationship manager in Stanbic IBTC Investor Services team, we deal with, quite a number of, foreign portfolio investors like yourself. And I would say that, those views are definitely something that they share. If we bring it home to Nigeria, I think maybe we can then touch on what is currently working for the country, what makes Nigeria as an economy or as capital market, juicy for foreign investors to come in. What has worked for us over the years? What has worked for us in the past couple of months with the COVID-19 restrictions that encourages your clients to come into the country with their monies to invest?
Okay, so when looking at this, they're actually considering Nigeria as a frontier market. Okay, it's good to see that there are actually a number of these boxes that Nigeria actually ticks, albeit a bit of work may still need to be done in some of these areas. So again, in no particular order, I'll start off with the issuance of green bonds. I mentioned the importance of ESG early on. Nigeria has been one of the leading lights in Africa. In fact, they were the first market to actually issue a green bond, and they've issued quite a number of them in the last few years at an exchange level, and that's really good to see. And this was done as this also keeps in line or makes it compliant with the Paris Climate Change Agreement. Dual listings with other global exchanges. This is good. Nigeria's started doing this, although I would urge them to continue in this vein and develop more dual listing relationships with markets outside of Africa. I know there's currently one with London Stock Exchange, but we would like to see more exchanges such as NASDAQ, as well as exchanges in the Middle East and Asia. And this is important because this will lead to a greater appeal to investors in international markets, as well as helping to generate more liquidity. Nigeria has a Karma Act for insolvency law, which will help clients such as ourselves retrieve assets in the likely event of an insolvency of any of our agents. Although I must say, the operational framework still needs a bit of work at the depository / exchange level. So hopefully that's something that the market can get together to work on. And also Nigeria has a Data Protection Act. So at least we can have that comfort and assurance that right now, even though the majority of staff are working from home, like we are all in this audience forum today, at least we can be assured that our data is kept safe and secure. So that's good to see. Nigeria also has 2 exchanges, with the Nigeria Stock Exchange achieving the status of the #1 performing stock exchange in 2020. And that's a fantastic achievement, and I must send our congratulations to them. Nigeria also has another exchange, the FMDQ, for fixed income products. They also have 3 depositories, although in my humble opinion, I think that's 1 too many. In addition, Nigeria has also implemented, or should I say, introduced a number of products recently, such as securities lending. And they also have 2 CCPs for derivatives, which are currently being developed. Blockchain. Now, in this current day and age, it's important to move with the times. And as we all know, when it comes to technology and innovation, blockchain is a key topic. With that being said, one of the depositories, the CSCS, have actually leveraged blockchain and now exchange corporate action information on a real-time basis for a wide range of equities and fixed income instruments over the bank's network. And I will end by saying the demutualization of the Nigerian Stock Exchange. It's, again, a fantastic achievement by the exchange. It's been a long time coming. And it is hoped that with that, the exchange will be more responsive to market needs. I think I'll stop there.
Yeah, thank you so much, Olu. Yeah, we're very proud of some of the things that you have mentioned. A lot of work has gone into achieving those in the markets, and the Association of Asset Custodians will continue, as always, and will continue to work with all the market operators to ensure that, more and more of these achievements are recorded in the market. So I think we should move now to your pain points. So we know that, a lot has happened over the past couple of months. And, we've tried as much as possible as a market to sort of ensure that, and quite successfully, if I add that, the capital market activities are not affected. So, from where you sit, what are the current pain points that you go through in terms of you and your clients' investments in the country? Based on your experience, what would you suggest are ways that these issues could be resolved and managed? And yeah, we'd really appreciate if you can share that. Thank you.
Okay, thank you. So I think I'll start with the elephant in the room. It's interesting listening to David early on. He touched on the US dollar liquidity challenges. So I'm going to start from there. And first of all, I'm sure all of my peers in the network community, as well as the foreign investors in this audience today, will all agree with me that it's very disappointing to see that the CBN declined the invitation to be present over the next 2 days, as this would have been a fantastic a fantastic opportunity for them to address our concerns around the ongoing US dollar liquidity issues, which have been live over the last year and a half. In the beginning, I mentioned that having access to market information and transparency, as well as having a free flow of currency, are some of the key points that investors use that attract investors in the markets in order for them to invest. Bearing these 2 key points in mind, as foreign investors, we would like to know the plans of the CBN in terms of clearing the backlog, which is currently estimated between 1.8 and 2 billion US dollars, and when would this backlog be cleared? Also, is there a strategy or vision to clear this backlog? Look, we fully understand the effects of this horrendous pandemic, as well as the negative impact of the Saudi Arabia/Russia price war on oil output last year had on oil prices, as well as the knock-on effect this had on the Nigerian foreign reserves. However, with that being said, surely it's not too much to ask for them to communicate with us and explain their strategy. We appreciate the fact that the CBN has started intervening in the INE window, albeit slowly with amounts of $20 to $25 million, sometimes twice a week, sometimes 3 times a week. However, we need more from them. We would also like the CBN to bear in mind that some investors are prohibited from participating in forwards. And as a result, this leaves those investors at a disadvantage. I would also like to plead to the senior management of stock exchanges, the 2 depositories, as well as the SEC, to collaborate alongside the Association of Custodians and reach out to the CBN, as this current US liquidity issue must be having a huge impact on them as it is on us. I want to conclude on this point by asking the CBN to bear in mind 3 very important points. 1, this is the 2nd time in the last 5 years that there's been a US liquidity challenge in Nigeria. And this US dollar liquidity issue is doing irreparable damage to the credibility and reputation of the Nigerian capital market. 2, the Nigerian Stock Exchange was the #1 performing stock exchange last year across the globe. Fantastic achievement. However, the US liquidity challenge was a hammer blow in terms of attracting more foreign investors to the market, as coming in to invest is relatively straightforward. However, when you want to repatriate, it becomes problematic right now. And last but not least, I would like the CBN to abide by their core values of customer focus and leadership. Under customer focus, it says on their website, one of the key themes is responsiveness. And under leadership, 2 of the key themes are courage and vision. Hence, I'm pleading to the CBN again to bear these key themes in mind by having the courage of their convictions to clear the backlog, as well as engaging with us by sharing their vision and responding to us promptly. Next in line as a pain point will be the removal of the dual account structure. First of all, it's great to see that after intensive lobbying from BNP Paribas, as well as my peers in the network community, that a market review was finally conducted to discuss removing the dual account structure. Before I go into that further, I think it's important to articulate why it's very important for us, why we want this dual account structure removed. As you know, all my peers are fully aware, as well as you agents, that the current model is not in line with international best practice standards. And Nigeria, along with a few markets in the Middle East, are the only markets that currently persist with this model. Indeed, some of these markets in the Middle East have already started work and having discussions to remove this model. And one in particular has actually moved away from it and now actually offers a single account structure. The dual account structure currently represents loads of risk, especially when you consider that Nigeria is a no-fail market. And as a result, if a broker made a mistake during the settlement process, the trade will still have to settle. And the broker may not be able to rectify this situation due to either market volatility, as the shares may no longer be available in the market, or the price may have moved against them, or there may be insufficient cash proceeds to buy back the shares. It is also important to be aware that there's also potential risk with the broker actually gaining access to the wrong accounts and moving this to the settlement account. We would like the market to look at alternative options to the dual account structure. And it's important to bear in mind that looking at alternative options can add a lot of significant value to the Nigerian market. As an example, rather than having a no-fail market, why not allow trades to fail? However, put mitigants in place to prevent those trades from failing. So as an example, mitigants could include securities lending and borrowing. Now, this is often used in many developed markets to reduce settlement failure risk. And this could also help enhance and develop the securities lending and borrowing products in the market, as well as help generate more liquidity. But especially when you bear in mind that the securities lending, so far, the traction has not been as anticipated. Buy-ins and sellouts can also be introduced. Overdrafts can also be introduced. And if trades are allowed to fail, the market can introduce market fines and claims as a deterrent, as this would encourage market discipline. As mentioned early on, it's great to see that the CSCS and the market have conducted a market review to discuss removing the dual account structure and drafted a paper by reviewing the current structure. Now, I haven't seen the full findings. However, a summary of the findings has been shared with the AGC. And there are a number of points in that summary that further clarification will be required on, such as, I'm surprised the Nigerian market didn't reach out to those markets I mentioned in the Middle East. As they currently have the dual account structure, they're also looking at removing it. And as I mentioned earlier, one of them has actually moved away from it. Secondly, the market would like to have 3 to 5 years before they can start work on a new alternative model in terms of after removing the dual account structure. But my question here is, why do you need 3 to 5 years? I know the report mentioned that a trust guarantee fund has to be increased and brokers have to recapitalize. However, my point here is that unless you have a new settlement model, why mention this? I mean, it would be nice to know if there is in fact a new settlement model. And if you have decided on an alternative model, why not work in parallel over the next 3 to 5 years whilst you're actually trying to increase the trust guarantee fund, as well as enabling or allowing the brokers to recapitalize, set up the operational framework for the alternative model. What are the milestones within this period of 3 to 5 years? This is certainly nice to have, as will help you and us to monitor track the progress. It's also suggested that segregation, moving the market to a segregation account structure only market. It would be good to hear the rationale for having this point. Now, I would like to conclude on the removal of the dual account structure by saying this. As the old saying goes, if you want to go far, you go alone. However, you want to go further, you go together. And with this in mind, I would like to urge the Nigerian capital market to collaborate and work together to adopt a best-in-class alternative model to the dual account structure. My last point, or last main point, is the lack of ISIN usage for OMOs and treasury bills. Now, ISINs are currently used by the CSCS, and the process works really, really well. No qualms there whatsoever. However, these ISINs are currently not used in the trading process, as the broker community are reluctant to move away from the current practice of using maturity date as an identifying reference for trade execution, as they want to factor in local nuances and the wider implication of adopting practices to avoid negative consequences. The market surprisingly also believe the current process supports market liquidity depth, and that changing this practice will adversely affect market development and growth. Now, whilst I understand where they're coming from, please forgive me, but respectfully, I disagree with this view. First of all, market trading globally is based on ISINs and not maturity date. ISINs have been used for more than 40 years, and it's the main traditional avenue for securities identification worldwide, with over 100 markets adopting ISIN codes. If ISINs are good enough for 100 markets, I'm struggling to understand why it can't be used in Nigeria. In line with international best practice, ISINs has to be adopted in order to avoid the confusion that we saw in 2019 around the accuracy of holdings. In fact, ISINs play an active and crucial role in easing discrepancies when trying to identify security correctly. Furthermore, ISINs are more precise than the maturity date. Basically, as in line with international best practice standards, we would like to see ISINs adopted as a unique identifier throughout the full securities transaction lifecycle, from execution to clearing to settlement. Now, the Association of Custodians and the FMDQ have been working really hard to find a resolution to this issue, and have proposed some additional solutions to get around the usage of ISINs. However, I'm sorry that despite and whilst your efforts to find a solution are appreciated and highly commendable, we cannot accept a compromise to best international standards. ISINs have to be adopted throughout the whole life cycle of a trade. How am I doing for time?
We're good, Olu.
Okay, good. Other issues that I would like to mention, the BVN. The CBN governor kindly assured us in London at a meeting 2 years ago that we will be receiving a letter confirming that the BVN does not apply to global custodians and foreign investors. However, to date, we're still waiting. So it would be good, we'd appreciate if the market, along with you, the Association of Custodians, can help push and continue to chase the CBN to get this letter confirmed and sent to us. Also, the CBN RTGS system, which has experienced frequent interruptions on a weekly basis over the last quarter. Please, again, to the CBN, this needs to be fixed ASAP, and we would appreciate if the market can engage the CBN on this matter. Also, full end-to-end connectivity from front to back with no manual intervention has to be implemented in Nigeria. And I guess with the removal of the dual account structure, this would help, as this will enable all elimination of operational risk. And last but not least, an operational framework for insolvency law is still not in place. Now, as I mentioned earlier on, there is an Icing for Karma Act, even though the Insolvency Act and the Insolvency Bill, Bankruptcy Bill, we've yet to actually hear the latest on that. But to fix the operational framework, it's important that the SEC collaborate with the CSD and the Stock Exchange to try and put something together in order to ensure that clients, investors, in the likely event of any insolvency in the market, can retrieve their assets in a pain-free, seamless, and timely manner. I think I would stop there for now.
Yeah, thank you so much, Olu, for those insights you've been able to provide. The markets, as well as the market operators, are well aware of these issues that you have highlighted in our discussion today, and we have been working along with the central bank, the SEC, CSCS, the FMDQ, the various exchanges. We've been working very closely to ensure that we get resolutions to all these issues. Regarding the dual account structure, conversations will continue, and we'll definitely share, timelines for execution of those, highlighted issues that needs to be resolved before the dual account structure can be implemented. Would also ensure that regarding, the FX situation, we will continue to keep you abreast of everything that is happening in the country. So we just want to appreciate, you for all the insights you provided. The AACN will continue to work with the operators to ensure that, all these issues are addressed appropriately. So I think at this point, we can open the Q&A session. So if you have any questions, you could type it in the chat box or raise your hand for Olu or for me.
Lola, we have a few questions. However, those questions are, I think are questions largely for David, but I can see a few questions. Okay, yes, there's a question for Olu from Ricardo Alexandra. Lola.
Okay. So Ricardo says there's a huge agenda in Nigeria and it takes time, and appreciate support from clients to help us to drive this. 1 second. T-Maj, do you mind reading out the question? I'm having some challenge here.
Okay, no question, Ricardo Alexandra says, just a comment. Great comment from Olu at BPSS. There is a huge agenda in Nigeria and it takes time, and I appreciate support from clients to help us drive this. Full stop. Hence the quote. The more we hear from clients is really good for all market infrastructure to hear this. So thank you, Thank you for those comments, Ricardo.
Any other question, Timaj?
No questions from my side and from the chat box at this time.
Okay. Thank you. Thank you so much, Olu, for your time and for answering us anytime we call you. We appreciate you. Thank you.
Okay.
Thank you, everyone. We'll end
It's a
the
real
session
pleasure
now.
to be here. Thank you very much.
Thank you. Back to you, Timaj. Okay.
Thank you, Ademilola Aluko, and thank you, Olu, again for giving us a view, first and foremost, from what it means to be a network manager, what your expectations are of the market, what it would take for us to have presence of foreign portfolio investors in the market, what the key messages to financial market infrastructures, such as the depositories, the exchanges are. I mean, there's quite a lot that has come from your conversation, and I understand that you're also speaking on behalf of your colleagues in the network management space, as well as other foreign portfolio investors. So thank you again, Olu, for honoring this invitation. We're doing well with time, ladies and gentlemen. Just to let you know that we did split the conference into two parts, day 1 and day 2, and that was intentional. Because we didn't want participants to spend the whole day at the virtual lectern. We wanted to give participants an opportunity to go reflect on conversations that we hold on day 1, and then day 2 will continue the conversation. Without much ado, we would like to go into the next item on the agenda. As we are aware, we have a new Company and Allied Matters Act, the CAMA 2020. Quite a number of changes were made in that act. Some of them were due to situations and the COVID pandemic. Some of them were due to some of the items that had been stale in the old CAMA, which was a CAMA of 30 years. That was implemented and accepted as a bill 30 years ago. In like manner, the Finance Bill of 2020, the government of the day have started adding what we call a finance bill to support the budget. And every year we have a finance bill that accommodates the budget, meaning that every year we expect to see certain changes to whether tax bills or tax acts. And as such, we think it's important for us to spend a few minutes speaking about this and also seeing what the impact is on portfolio investments going forward. We have no other person to take this section than Mr. Olutoyin Ajomalade. He's the Regional Tax Manager from Standard Chartered Bank, and he will be guiding us on this conversation. Please, you could use the chat box and the Q&A section for questions relating to CAMA bill as well as tax. I would therefore yield the virtual lectern to Mr. Olutoyin to guide us on this conversation. Toyin, over to you.
Thank you, moderator. It's afternoon, right? All right, good morning, ladies and gentlemen. Thank you for having me. My brief this morning is to quickly do an overview of the Finance Act, the changes introduced by the Finance Act and CAMA. So I'll dive straight into it because of the limitation of time. As we are all aware, most of our tax statutes and laws have been moribund, very obsolete. Starting with 2019, the federal government went back to the era of issuing Finance Acts, which basically was intended to bring modifications to our archaic tax laws, drive revenue generation, change the laws based on a few feedback that has been provided by practitioners. In 2020, following the enactment of the Finance Act of 2019, Finance Act of 2020 was also promulgated. It was also passed, which portends a lot of good for our country. The Finance Act of 2014 actually touched about 14 statutes, ranging from the value-added tax, this capital gains tax, personal income tax, tertiary education fund, or what you call education fund. It touched on oil and gas exports free zone, so many other acts that it touched. And the highlight of some of the changes, which is sweeping, cuts across personal income tax and the rest. But this morning, I'll just zero in on a few, but I think we'll be more interested in. So let's start with some of the changes introduced for non-resident companies. Prior to now, non-resident companies, for them to be taxable in Nigeria, would have fulfilled some basic requirements, which include creation of a permanent establishment or having a physical presence in Nigeria. Would also have been required that such organizations will also probably be carrying out a turnkey project in Nigeria, or would be operating using a dependent agency. However, in 2019, this concept of significant economic presence was introduced, and what significant economic presence implied, and it was introduced more in the personal income tax space. But with the 2020 Finance Act, we introduced a significant economic presence for companies. And what that intended to do is to say that any organization, non-resident, that makes taxable income in Nigeria, that makes income in Nigeria, will be taxable in Nigeria. As with most of the things that we come up with, there were a bit of ambiguity around this, because then it requires that you will, as a non-resident company, be required to submit tax computation schedules based on the profits that is attributable to Nigeria. The question then comes and says, how do you measure profits that are attributable to Nigeria operations? The Act particularly expects that non-resident companies, NRCs, would file their tax return, they have a local financial statement, and also submit their global financial statements. This definitely begs a lot of question, because it does not provide specific guidance on how to determine profits attributable to Nigerian operations. Also, the law grants the FRS the power to assess companies on a deemed profit basis. It is likely that the FRS would accept tax returns prepared on a deemed profit basis. So that definitely is one of the changes in the non-resident company area. There's also that requirement that you need to register for VAT, value-added tax in Nigeria, if you are deemed to be making a VATable supply or VATable service. So irrespective of whether you are resident or non-resident, the provision introduces material administrative burden on many non-resident suppliers. So which means that once you do a non-resident supply or service, then you are required. The Act also requires that or provides that these non-resident companies can actually appoint fiscal representatives. A non-resident that makes taxable supply to Nigeria may appoint a representative in Nigeria for the purpose of complying with this obligation. We've seen a few organizations move in that regard. However, it's still also very much unclear how the FRS intends to administer this. I said earlier that the significant economic presence law was established for companies. So in line with the changes that was made with personal income tax, CETA now says that anytime that you make taxable income attributable to your operations in Nigeria, and it must be said that the real targets were the digital companies. But however, they made sweeping pronouncements around all non-resident companies. So that means that there is a further requirement, and then also to corroborate their intention to bring as many organizations under the tax dragnet, the minimum tax that is payable, which is to that 0.5% of gross turnover before the Finance Act of 2020, now became 0.25%. So which means that if you are registered for tax in Nigeria, or if you are deemed to make taxable profit in 1 year, and you are registered, even when you have years where you probably are not deemed to make attributable profit in Nigeria, you will still be required to file minimum tax. Definitely, these are more administrative requirements on the organization. Then there's also the issue of which I think to a lesser extent may affect us, the introduction of the electronic money transfer. Prior to that, there had been the Stamp Duty Act, which has existed for over 50 years, which did not make clear representations around some of the contemporary issues that relates to stamp duty. So the introduction is an amendment of the Stamp Duty Act, expects that every transfer that is done with a threshold of 10,000 and above now attracts an electronic money transfer levy of 50 naira per transactions above 1,000 naira, 10,000 naira, I mean. There's also the issue around unclaimed dividends of publicly quoted companies and unutilized funds in dormant accounts. Interestingly, CAMA, which was just amended from the 1990 CAMA to the 2020 CAMA, had had amended saying that unclaimed dividends, when dividends are declared and they're unclaimed for 12 years, it is only after 12 years that the company will plow it back as a distributable profit and then share it amongst the shareholders. But the Finance Act of 2020 says, no, after 6 years, if there are unclaimed dividends, all the organizations that are involved would have to transfer such money into a fund known as the Unclaimed Funds Trust. So it's a created trust fund. The government created a trust fund where any unclaimed dividend above 6 years and above should be transferred to this fund. The way it was meant to work is that it then becomes a debt owed by the federal government or the government who created the trust fund. Of course, I'm sure there are many questions around that. So I'm sure in the question and answer session, we may deal with some of those. There's also the International Tax Treaty and other exchange information. Of course, you know that Nigeria is a major signatory to many of these. Some of the things that are driving this additional information requirement are the automatic exchange of information and the double tax treaty obligations. So that requires also that FRS would prescribe in a manner that is described by them to organizations. And so they would need to prepare and submit their returns of transactions involving the specified sum. So such information would include the name, the addresses, and other information, including the amount, the recipient, and the rest that are meant to be. Other changes that have been introduced by the Finance Act, of course, up to a lesser extent, would be the changes around benefits from tax incentive on loans. But this is loans granted to agricultural production. The Finance Act redefines what agricultural production. It restricted it to primary agriculture. So no longer, cash no longer covers every aspect of agriculture, and also as an incentive reduces the moratorium. It used to be 18 months moratorium, but it brought it down to 12 months moratorium. That's also significant to note. There's also the clarification that was provided in respect of the real estate investment companies. Real estate investment companies, going forward now, dividends and rental income earned by them is exempt from income tax. But there's a proviso also that within 12 months of the end of the financial year in which the income was earned, it must be distributed. So anything that is not distributed at that period, given that period, would now be subject to income tax. very significant. I mentioned earlier reduced minimum tax rates. There is also the deductibility of donations. I don't think those are the notice of assessment. Also now the FRS, the Finance Act now makes it possible to do your amendment, to do your returns and filing electronically. But we'll see that when I touch some of the changes that was introduced by CAMA. There's also the, which I think will also be relevant for us, the changes to capital gains tax. Now there's a compulsory obligation to remit CGT. Is a requirement to self-assess and remit CGT either on the 30th of June or the 31st of December, whichever is closer to the period in which the capital gains is realized. And it will be significant also for us, especially with the pending expiration of the executive order that granted exemption to treasury bills and government bonds. Towards the end of this year, there may be a falling off of the exemption to TBs. So that may significantly also change the outlook. So what's the implication? Most of the changes that have been introduced actually, which affects the banking sector and the capital market, simply imposes additional compliance obligations on these companies. You now have to manage the EMT levy, the UFT levy. Those are the two levies that were created. A few changes also would have positive impact, the agricultural loan stuff and then the rest. Most of the other changes introduced by the Finance Act really would not basically affect us, but I assume that we are aware of them. For example, the redefinition of what a taxable supply is, and then also the electronic businesses taxation. So CAMA, also in line with the typical environment where laws are not changed often, CAMA eventually had a change in 2020, moving from the 1990 CAMA. Like I said, one of the major changes is around the dividends that's allowed you to claim up to 12 years, and then before it is transferred to distributable income. But now, as amended, companies that are listed on this National Stock Exchange must pay unclaimed dividends after 6 years to the unclaimed dividend trust fund. So once it is in this fund, it then becomes a perpetual debt owed by the federal government of Nigeria. Your thoughts will be as good as mine, and then there are still some questions. CAMA also made sweeping changes to SMEs, which I think may not really affect us, but just a brief highlight of those is the fact that SMEs now can focus more on their development and growth. A single director for small companies is now allowable. Single shareholder companies for private companies is now allowable also. There are higher thresholds for more companies to qualify for this small company categorization. There's no need for audited accounts for them. And then there's also no need for a company secretary. The CAMA also introduces a lot of electronic innovations. So service of notice can now be done by electronic mail. Documents can be signed electronically. Electronic share transfer instruments are now allowed. You can keep copies of your company books and registers electronically. Electronic filing of documents is now allowed by CAC. Private companies can hold their annual general meeting virtually. These are good developments. There has also been some changes around the space of share capital, where authorized investors issued share capital and paid up capital were now looked at again. So company below their minimum issued capital, it will have implications for them. Companies on issued share capital. There's also the preemptive rights. So it is now mandatory preemptive rights for existing shareholders in relation to the issuance of new shares. There's no room for exclusion in the articles. It applies to all companies, whether private or public. So the new provision previously left to regulation by companies in their own articles, but now there's a provision beyond the articles and association of the company, which CAMA has put in place. So what are the implications of this? Public companies must now conduct a rights issue before they can allot shares to third parties. There's also the impact on the transaction timing, because the time limit has now been introduced by the CAMA change. There are also changes around the mergers and acquisitions structuring consideration. This is meant to introduce some board dynamics and also address some of the funny play that we see happening now. As far as registration of security under CAMA 2020 is concerned, there's a reduction in the filing fee. There's also a provision around negative pledge. Then there's also a constructive notice that must be given. There's also ample protection for minority people, minority interest holders. And then there are a whole lot of changes also around the corporate structures. You know, there are now LPs and LLPs. There's also acquisition of private companies that are changes. I wanted to keep this more interactive. So these are just the general overview that I presume would be relevant to you, but we can cover any other aspects in question. So I'll stop here. Thank you very much. And I'll wait to take some questions.
Thank you very much, Mr. Olutoyin. Quite detailed, I must say. I mean, and the conversations around what has changed over the years with respect from a tax perspective, as well as from a finance bill perspective. I will check quickly if we have questions for you, the chat box, or if we have. Okay, we have a question from Mr. Debimpe. Biodun, can you go ahead?
Yeah, thanks very much, Mr. Jomolade, for the very insightful and detailed presentation. My quick question for you is, because we have a number of foreign portfolio investors at this session today, so would you say in a nutshell that there are no significant changes in terms of tax implication of the Finance Act 2020, aside the change in VAT rate?
Yeah, absolutely. Thanks, Bingbe. Thanks, Jordan. Yeah, that's pretty much it. Most of the other changes may not significantly affect non-resident investors. You know, so there are things like the change in what is called the excess dividend tax, but I don't think that affecting many changes around the VAT space. So yes, I would say yes. Apart from the requirements, extra compliance requirements and requirement to register, the changes are minimal. Thank you.
Hello? Yeah, thank you very much, Biodun. Oh. We have another question from Benedict Adomokai. Benedict, could you go ahead with your question?
Thank you, Tunde. Just a quick question. Can you hear me?
Yes, we can, Crystal.
Can you hear me? Okay, yeah, Tunde, just a quick question. Toyin, a quick question. You made reference to registration requirements as one of the things impacting on foreign portfolio investors. Could you elaborate on what that means, please? I didn't get that.
Okay, so twofold. So I said with the introduction of the significant economic presence and then also the obligations around automatic exchange of information. Now, the Finance Act of 2020 now requires non-resident companies that are taxable in Nigeria, including those that only create a digital SEP, even if it is just digital. That's a significant economic presence. They are now required to file CIT returns, CIT is corporate income tax returns, which will comprise complete audited financial statements of their global operations and also a financial statement of their local operations. The local FX should be certified even by an independent certified accountant. So that then means that in times past, prior to the introduction of the Finance Act 2020, this wasn't a stringent requirement. Non-resident companies who make income in income in Nigeria will simply be assessed due to deemed income. So which also means that 20% of such income is deemed to be derived in Nigeria, and it is taxed at 30%. But now there's a full disclosure requirement. And then the interesting part of it is also to corroborate those filings, you would now be required to put your global financial statement. That's one. There's also the need for VAT registration. VAT is value-added tax for non-residents. The Finance Act of 2020 requires non-resident persons that make taxable supply of goods or services to customers that are registered, that are in Nigeria, to register for VAT and obtain a TIN. That's the pronouncement of the Finance Act of 2020. You will register for VAT if you make a taxable supply in Nigeria and taxable supply of services. And also you will need to register for VAT. And then given the fact that it is now consolidated, getting a TIN number registers you for VAT. So those are the two requirements that I mentioned, registration requirements. I agree it will bring material administrative processes, but that's it.
Thank you very much, Olutoyin. Just a follow-on on that, where the non-resident is not providing a service, a taxable service in the country, will they be subjected to this rule as well?
No, they won't.
Okay.
They won't. So long as they do not, they are not providing taxable services.
Thank you. Just last, do we have anyone that has any other question or a follow-on question? Okay, thank you very much. In the interest of time, I would like to thank you, Mr. Olutoyin, for honoring our invitation and giving us a view from a tax perspective. This is quite useful, and I'm sure the attendees and guests would have a lot of takeaway from this. So thank you again, and we appreciate your presence. Thank you.
Thank you. Thank you for having me. Enjoy the rest of the Congress.
Thank you. Ladies and gentlemen, we have come to the end of today's session. Like I said in between, I said it was deliberate not to have a full day session so that we have time to go back to other commitments that we have. But we also want to let you know that tomorrow will be a focus on, and like I said initially, we'll start off tomorrow early on. We'll start off at 9:30. We'll have a follow-up conversation on the macroeconomic outlook for Nigeria. We have the IMF resident representative starting that conversation, Mr. Ari. Thereafter, we'll have conversations with the exchanges. So we have the exchange and all the exchanges will be here present tomorrow, and we'll be talking about the future of financial markets, and we'll have a panelist conversation and discussion forum on the key changes that have happened in the exchanges as well. We have a forum also for depositories. We have all the depositories they will be here to answer your questions around key changes in that space, what is changing in terms of rules, policies, as well as what new securities are we expecting going forward. So that session will hold tomorrow as well. We also have a session on derivatives clearing. We'll be speaking, and the DG alluded to the fact that to support the derivatives market, the SEC in their wisdom gave approvals to two entities to act as CCPs in the market. We have both CCPs will be here tomorrow to discuss extensively about what the depth of the market is and what the future is, especially for investors. And then they will also roll and display and present what their operating modus operandi will be as they move into the operational phase. We also have a conversation. We also have a conversation tomorrow on cybersecurity. We understand that now that most things have gone virtual, the risk of doing things online have also increased. So we'll have a cybersecurity expert who will be presenting to us what we need to watch out for and how we can be safe within the cyberspace in the realm of the new normal. Following on, we have a conversation on cryptocurrencies and emergence of digital currency. So we have someone who is highly skilled in that area who will be speaking to us tomorrow, Mr. Mobolaji Onibudo. And that will be the wrap for this year's conference. So ladies and gentlemen, we would be expecting all of us to dial into tomorrow's session. We start off early Nigerian time or West African time, 9:30, and then we'll carry on the conversation till 12:30 at noon, just after noon. The login credentials remain the same. Nothing is changing with respect of the login credentials, so you don't need to re-register for the conference again. The same registration link that has been provided to you is the same that we expect you to use tomorrow, and we'll be happy to host you once more. On behalf of the AACN, the Executive Committee, as well as the conference committee, the Nigerian Day Investors Conference Committee, I would like to thank you all for the time you have spent with us virtually today, and we hope to see you in the morning at 9:30 West African time. Thank you.